Hi. Let's learn about the Loan Life Coverage Ratio, LLCR. The Loan Life Coverage Ratio is a financial ratio used to estimate the solvency of a firm or the ability of a borrowing company to repay an outstanding loan. It is calculated by dividing the net present value, NPV, of the money available for debt repayment by the amount of outstanding debt. The LLCR formula is sum of cash flows available for debt service at year T divided by the debt balance outstanding at the time of evaluation. This ratio takes into account the time period, the weighted average cost of capital, and a cash reserve available to repay the debt. The LLCR can be calculated using the formula provided, or by dividing the NPV of project free cash flows by the present value of the debt outstanding. The weighted average cost of debt is the discount rate for the NPV calculation, and the project cash flows represent the cash flows available for debt service. LLCR is a solvency ratio that measures the number of times over the cash flows of a project can repay an outstanding debt over the life of a loan. The higher the ratio, the less potential risk there is for the lender. It also considers the risk profile of the project and may include covenants stipulating LLCR levels in project financing agreements. The debt service coverage ratio measures net operating income as a multiple of debt obligations due within 1 year. LLCR addresses multiple time periods and is suitable for understanding liquidity available for loans of medium to long time horizons. One limitation of the LLCR is that it does not pick up weak periods, as it represents a discounted average that can smooth out rough patches. As a rule of thumb, if a project has steady cash flows with a history of loan repayment, the LLCR should be roughly equal to the average debt service coverage ratio. Here are 2 key takeaways. 1. The Loan Life Coverage Ratio, LLCR, is a financial ratio used to estimate the solvency of a firm, or the ability of a borrowing company to repay an outstanding loan. 2. The Loan Life Coverage Ratio is a measure of the number of times over the cash flows of a project can repay an outstanding debt over the life of a loan. The higher the ratio, the less potential risk there is for the lender. Hope this would help. Thanks for watching.